Hi there, Etoro. It is Monday the 21st of November, and that means it's time to take a look at what moved the markets last week. Beginning with the charts, not a hell of a lot happened through the past week. So I measure the difference in price activity from Friday to Friday last. And so the NSDQ100 was up 0.5% over that period. The S&P 500 down 0.5% over that period. The CSI 300, the Chinese markets, 0.33% over that period. And the dollar, whilst climbing from the lows that we have recently seen, hasn't been as volatile as we have seen through the past few weeks. So why the lack of activity in the markets? Well, let's start by taking a look at the US. Let's look at some of the macro data that came out. Retail sales, US retail sales. This number came in a lot hotter than expected. It came in at 1.3 versus the consensus of 1. And if you pause the video and take a look at this paragraph, you can see the things that contributed to those prices. So sales at motor vehicle dealers, as an example, up 1.3%. Prices of gasoline pushed up sales at gas stations, petrol stations in the US by 4%. The market didn't like the surprise in the retail sales number because if people are spending a lot of money, then there's the potential for inflation to stay higher for longer. On top of this, and maybe the biggest influence in price action last week was the Fed member James Bullard coming out and being very hawkish. Now, one of the Fed's tools, one of their primary tools in affecting prices within the markets, keeping them within the range that they want them to be, is what they say. And so James Bullard was probably responding to the big jump in asset prices that had come the week before, and he then said previous interest rate rises had only had a limited effect on observed inflation, which makes sense. But of course, all of the interest rate rises that we've seen haven't yet affected the economy. And then he took it a step further and he said that he thinks that the interest rates could be between at least 5 to 5.25%. And once again, they reiterated this message of holding it there for a while. Now, in previous bear markets, we have seen the Fed pivot quite quickly. I don't think we're going to get that this time around. I think it's likely that rates are going to increase. And instead of seeing a very sharp pivot, there's going to be a pause in those rates before the rates start coming down again. And the market is realizing that this is the most likely course of action. In addition to this, out of the US, we saw building permits as well as existing home sales. Both came in slightly higher than forecast, but it's important not to just look at the number in isolation when the macro data is released. We also need to look at the trend, and here we can see that existing home sales are now as low as they were during coronavirus crash. So this number has come down quite significantly. And in my opinion, the housing area within the US market is one of the things that could break if they carry on hiking aggressively. Now jumping across the pond, so we saw the CPI number out of the UK last week too, and that number came in much higher than had been expected. So there was a jump up to 11.1%. Analysts and economists had expected this number to come in quite hot because October was the month where the UK saw the prices of energy increase to households and businesses. I'm not sure how they could have gotten it so wrong though. The real number is much higher than the expected number. The silver lining on this very dark and grey cloud is that there's a government mandated cap on energy prices, at least for the next 6 months. So the rate of change here will be less affected by energy prices, which were a huge portion of the increase in CPI, in the CPI number that we got last week. Probably the most interesting thing for me personally and UK citizens on the ground was the autumn statement. So this is the replacement budget for the budget speech that not so long ago crashed the pound and created all that havoc in the bond market. There were no real surprises. I think a lot of the big ticket items had been leaked out to the market early so that when they were announced, there wasn't a huge shock. There were many bitter pills to be swallowed in the statement, but I think given the situation in the UK right now, it is probably a better course of action. It's definitely a better course of action than the budget speech that came before it. So the government is looking to raise a huge amount of money. Half of this money they're looking to raise by increasing tax rates. And they did, I think, a fairly good job. There's no one area of the economy that's going to take a huge hit when it comes to taxes, at least the taxes announced in the statement. And the other half of that amount of money is to come from cuts to services. The UK is now firmly back in austerity land, and the OBR has said that the UK has probably been in a recession since Q3 of this year, and they think that that will last until Q3 of next year, so roughly a 1-year-long recession. And finally, taking a look at China, so there were quite a few interesting things that happened in China last week. The macro data coming out of China has shown that the participants in that economy don't have a lot of confidence in that economy, so they're not spending. I think that this is something that most people knew, at least anecdotally, but they didn't realize how bad the problem was until the numbers came out last week. Consumers don't want to spend money, even though there's a lot of access to fairly cheap debt within the economy right now, because they would prefer to hold on to that money and save it for a rainy day instead of going out and splurging it in the economy. We've also unfortunately seen a re-implementation of the zero COVID policy just a week after they seem to be loosening those policies. And this is starting to create issues, domestic issues within China now, because people are tired of the stop-start of this zero COVID policy that the government forces upon them. I know that I've spoken about its impact on the Chinese economy and Chinese assets, but on the ground there are lots of people that are just trying to make enough money to survive, and this is making it very challenging for them day to day. And one piece of good news, just to offset some of the grimness that I've spoken about, and probably the thing that I found most interesting coming out of the G20 summit, is that China has reiterated that nuclear war should never be fought. There were a few other very interesting statements. Xi is by no means abandoning Russia and their war in Ukraine, but he has demonstrated on the global stage that he considers China to be more neutral than most people thought prior to the G20 summit. All right, so what's happening this week? Well, it's going to be quite a quiet week. Thursday is Thanksgiving within the US. Friday is a day that most people in the US will also take off. The markets only operate for half of the working day in the US. Friday will also, of course, be Black Friday, that retail event that seems to be celebrated around the world now. And following that, we will see Cyber Monday, another big sales kind of holiday in the US and now globally. There is some macro data coming out of the US on Wednesday, and some of that will be very closely watched. Jobless claims is one area within the US that's been watched by investors because they know that the Fed is watching that. And the minutes that we get out of the Federal Open Market Committee meeting will be poured over for details in the hopes of finding tidbits of information that the Fed might be putting out there with regards to its policy setting in the short and medium term. All right, that's it for this week. Have a good one. Speak to you soon. Goodbye.